Hi, I'm Jeff Hirsch. I'm here at the Money Show in San Francisco with Vice Chairman Dan Fuss of Lumi Sales, and you're also institutional bond or fixed income portfolio manager.
Yes.
Correct. All right. So you've been around for a long time. You got a lot of wisdom. What are the factors that are affecting the market, the bond market, fixed income, and also equities?
Well, the number one factor is actually the geopolitical side, Jeff. You have this thing, the emerging market, emerging power meaning the established power, but
like China, right?
China meaning the U.S., and all the sideshows that go on around that with other relationships.
You got Japan and Korea going at it too?
Yes, old history there. And you've got that going, and that makes the market nervous, number one. Number two, it affects funds flows big time. Flows that are coming that are hard to track. You know they're there. You can't measure them as well, except for the long lag.
Is that kind of what pushed us into that inversion there, or the money flowing into the U.S. fixed incomes?
You know, that's part of it, and that pressure to buy at the 2, 3, 4, 5 year range.
Right.
That's part of it, and an important part of it. Now, that has a track record, but the track record is coincidental primarily. Still some fundamentals under it. But money flows towards the U.S. market. Of the reserve currencies, the U.S. dollar gives you the most return on government debt. Okay.
So you got geopolitics affecting it.
Right.
And
well, let's go right to the Fed. The central bank, our central bank, the Fed, is looking at this, and they're saying, well, okay, we have the other major reserve currencies out there, but we're the whopper. We're, depending how you measure, we're 70-some% of the total,
right.
And we have the highest yields.
Correct.
So there's an incentive to bring the money to the U.S. We don't need it, per se.
How's the Fed reacting to that, or how is the reaction impacting things?
Quite frankly, it puts them in a trap. There's money that's coming to this country for safety.
Right.
There's money going to Japan for safety. There's money coming from the other parts of the world for safety, and some money actually goes to the euro despite the rates for safety. Understandable under the current geopolitical setting.
Right.
So the Fed is looking at this and saying, well, that's all the more reason for us not to take rates up and perhaps take them down a bit. And then they worry about, well, inflation and so forth. But at the increment, you have a lot of reaction now verbally in the business community saying...
Geopolitics, uncertainty causing money to flow to the U.S., dropping the rates, causing the Fed to lower rates.
Yes.
And then there's the structure, the nature of the bond market that's creating this issue.
Well, the stock market's pretty good shape as far as liquidity. The bond market is not. The middle of the bond market used to be populated by a good number of investment banks carrying sizable inventories. Okay, that was fine. So if you wanted to buy, you knew where to go. If you wanted to sell.
And the middle being
the investment banks.
The middle of the curve is the...
No, the middle of the market itself.
The middle of the market, sorry.
Yeah, the inventories.
Correct.
If you want to buy shirts, go to the department store. Well, that's the way it used to be. Now, you get there, and the middle of the market is, relative to the size and in absolute terms, is much smaller. You don't have as many people, and the market is thinner. That doesn't mean all the money's gone away, but it's no longer in the hands of people who are responsible for maintaining a market.
Is that because of Graham Dodd being...
No.
Glass-Steagall being canceled?
The investment banks at this level of interest rates don't want to take risk with inventory, so they cut it. Now, there are other people who are willing to take that risk, but they are private investors. Many are hedge funds, many are not. But they'll reinforce a short-term move in the market rather than go against it.
They're trading it.
Yes.
Kind of the algos.
You got it. And as a result, you get this chop, chop, chop. Normally doesn't bother. But if you get into a more extreme situation, like the last couple of weeks in the high-yield market, for example, then your liquidity goes away unless you mark it down a lot. And so any selling that has to be done really punches down.
Geopolitics, making everything uncertain,
Yep.
the Fed reacting to it, and
Yep.
the fact that there's no market makers in the middle, creating this sort of choppy market we have right now.
You got it.
Well, thank you, Dan, and thank you, everybody, for joining us.